And so one of the biggest challenges with marketplaces is kind of getting this chicken and egg problem, right? Like you have to get one side to get the other, and I find that in most marketplaces I see that one side's harder than the other to get, and you sort of have to go and incentivize the hard side. Like, can you talk about how you did that?
Yeah, so I think that was, a lot of what we heard early on, or what I heard especially early on, was you'll never build an exchange for advertising. You won't get the principal buyers and sellers to participate until there's liquidity, and you won't get to liquidity until the principal buyers and sellers participate. And that had been proven out by a bunch of guys whose names you can't remember who tried this earlier. And what we did was we said, well, that's probably true, but if you get the intermediaries to see the upside of having a common platform, then you can get to liquidity, which will then bring the principal buyers and sellers. So what I mean is, if you get the networks to play, which is counter.
So you sort of have the advertisers, the networks of the intermediaries, and you have the publishers, and you sort of said, let's insert ourselves between the publishers and the networks.
Well, no, what we said was actually, so what everyone had tried to do before was they always tried to insert themselves as a replacement for the network. You don't need a network anymore if you
go right to the publisher and right to the advertiser.
Yeah, which, I mean, when you look at other when you look at like the financial market analogies, it doesn't really make sense. Just because you have an exchange doesn't mean you don't have traders, right? It's not like, everyone's just, managing their own buys and sells. In fact, it creates a market for traders to have a liquid exchange. And so, it was not easy, but what we wound up doing was we had our own network. And it was already running on the sort of predecessor platform to the exchange. As we built it out to be a software as a service, an ASP, we wound up going to several other networks who we were friendly with and basically convincing them that life would be better if we all shared supply and demand, because in that business, one of the challenges of the network business, and I think this is still true today, is you'll have a month where you have great demand and not enough supply, and then the next month you'll have not enough
So this is a way to kind of level out sort of utilization or something like that.
And it was happening anyway. This competition was happening anyway, where one network would call the other network and say, "Hey, I got a big IO. Can I get some supply?" And the network would go, "Oh, great. I'm short on demand this month. I'll shift you over." And it was all happening behind the scenes, really inefficiently. And so what we said is we can make that all automate. And the end game was always to have a vibrant marketplace where buyers and sellers and intermediaries all played together. But getting to critical mass and liquidity was really about getting the intermediaries to embrace it first.
And then, I don't know if there's other parts along the story you want to tell, but from my outside perspective, what I saw was sort of at 2007, a lot of, Google had won direct response advertising, was then thinking very seriously about moving into display advertising, bought probably the premier asset in that space at the time, what was perceived to be, which is DoubleCli. Although DoubleCli actually wasn't an ad exchange right at the time. They were simply doing the Dart technology. I think there's a common misconception about that. They didn't actually have an ad exchange. They'd actually sold that off.
No, well, they had never had an ad exchange. So I think that DoubleCli was a media network first, which they sold in 2002.
But they didn't even have inventory. Like they'd sold off the media business.
That's right. Yeah, at that point they were a pure technology provider. But it was controlling. I think they controlled something like 60% of the ad impressions from a technology perspective.
So that's a wedge into.
So it was
selling.
An easy move for them to. Well, relatively. I mean, the technology piece is incredibly difficult because you're taking something that's designed to be individual instances. So if you think of the network, you take something if you design a network to be lots of individual instances of the same technology, it's very difficult to then go create a networked instance of that. It can be very difficult from a technology standpoint. Whereas we started from we're creating a nodal network system that allows everybody to talk to each other really simply from the beginning. And so I think once we proved at that point, probably by 2007, I don't remember the exact numbers, we were doing hundreds of billions of ad impressions. Through the exchange. Once we had proven that the exchange was for real and it was real opportunity, then others started to pursue it, and some of them had very like DoubleCli had a big strategic position too, from which to launch their kind of market.
So sort of as I saw from the outside, Google bought DoubleCli, and then I don't remember the exact timing, but you guys were acquired by Yahoo. Microsoft made their biggest acquisition in history, $6 billion approximately for Avenue A, which is pretty shocking. I mean, Microsoft is not known for those kinds of huge acquisitions. So there's clearly like some real interesting market dynamics going on.
It was a wild time, yeah. It really started. It didn't start with the sale of DoubleCli. It started when DoubleCli went on the market.
Okay.
So
they've been taken private, and then they sort of like Hellman and Friedman or something.
Hellman and Friedman had taken them private.
And they sort of said, "Hey, we're going to sell this." And
they hired a banker and said, "Look, this market's hot. Everybody wants display. Display looks like a big growth engine." And I mean, I wasn't in the room obviously, so I don't know what was said, but that's what it felt like. And all of a sudden, everything started buzzing that DoubleCli's on the block, right? And so I was getting calls from bankers every day saying, "Hey, let's get some private equity guys and let's go buy this thing and put it together with the right media and we'll just dominate, as the next new big." That idea was out there, and that I don't think there was enough capital to make that work, especially once Google and Microsoft and those guys got into the fray. So. I think what happened was it became clear at that point that it was a decision point for everybody. It was the point where you either have to participate in that market frenzy that one event was going to start. As long as DoubleCli stayed independent, no one else had to do anything. We certainly didn't. Our feeling was always that we were, as an exchange, we were probably better positioned as an independent company, which is one of the reasons why the investment from Yahoo was a minority investment. And at the time, obviously the M&A conversation had come up. And so when DoubleCli went for sale, it was a game changer, because if that DoubleCli got bought, which it was expected to by one of the big principal players, one of the big principal advertising players, then you were no longer going to have this sort of environment where the technology providers were independent. And once one went, then they were all going to go. And so that was fairly clear. And so you're trying to figure out, well, where do I want to be in this sequence, and who's the right partner for me, and how do I trade off maximizing value against winding up in a place?
You'd already done the Yahoo minority investment. Did that limit your flexibility at all, or? Because that's always an interesting debate, right? With venture-backed startups, do you take strategic investment? Does it limit your flexibility in terms of being acquired by competitors?
Obviously, they had some favorable terms, but we had also thought really carefully about how to structure that deal in a way that it didn't prohibit us actually making a market for the company if we wanted to, or allowing the market to come to us. And so, I think that the reason why that minority deal got done was because Yahoo was very reasonable about that. They knew we weren't. They certainly weren't going to let us, sell the company without them knowing, right? But they weren't requiring.
So they kind of a look, but not the right of first refusal kind of thing.
I mean, just from the entrepreneur's perspective, I think strategic deals can be really hard, and particularly because as a strategic investor, and now I've been 2 years in Yahoo, I've been on the other side of that conversation also. Your instinct is to say, look, I basically want to have, when another company tries to buy this company, I want them to look in. I want their first diligence item to be, show me your rights of first refusals and things like that, and then they're not going to want to buy the company. So basically, I get it for a minority, right? And we were extremely careful about making sure that we structured the deal in such a way that, while they certainly had an edge, not just an ownership edge, but also certain accessibility edge, we could go to anybody.
I think sometimes what people don't understand, this also applies to venture deals, maybe less experienced people don't understand, is a right of first refusal, or like a right of matching the best offer.
Right.
In theory, appears like, okay, I'll get a great offer, and then they'll match it, and I'll still get a maximum price. In practice, once anyone else sees that term, they don't want to make a bid, because they don't want to be a stalking horse and just be like a price setter and be used. Right?
Yeah. I think in most cases.
And that also applies to venture deals as well. I think,
I think in most cases that's true, and I think that was really if I'm giving advice, what I'm saying is right of first refusals are really dangerous. Right of notices, notifying partners, and even giving some time to make a first offer. Right, very big difference between right of first offer, first solicited offer, and right of first refusal are two extremely different things, and so.
And I think one thing is implicitly when you do a venture, just a Series A of venture deal, implicitly often the VCs will have a right of first refusal, just in the sense that they may have blocking rights, for example.
Sure, yeah.
And that creates the same kind of, I've found in Series B fundraising, same kind of dynamic that happens where you have outsiders who don't want to be a stalking horse, and there's sort of this complicated kind of dance that happens.
Yeah, I think that's right. I mean, I think it's an imperfect system, and even pro rata rights can lead to these awkward conversations where it's just an escalating
and that's when you get sometimes these monster rounds, because everyone wants more in their pro rata, and then you end up determining the amount of money raised by
the valuation goes up, so that it is an interesting dynamic.